Welcome to the Millionaire Next Door podcast with Robert Curtis, CFP accredited investment fiduciary from Signature Estate and Investment Advisors. In this podcast, we help successful wealth accumulators like you looking to transition to a work-optional lifestyle by helping you build strategies for growing and maintaining your wealth. Robert draws from years of experience and fiduciary responsibility and interviews guest experts to help you build reliable strategies to grow and maintain your wealth. Now, on to the show.
Well, hello, everyone, and thank you for tuning into the Millionaire Next Door podcast. Again, really excited. We have a terrific guest today. We're going to go deep into our process today and some of the tools that I utilize to give people a little bit more, look under the hood, help them understand the process we go through. That's incredibly valuable. Really pleased just to present all these guests. We're getting terrific feedback. This is really a zero cost to consumer resource. So we're really happy to share all the things we're finding and what we're doing. Just to share practice management wise, we're still taking on clients where it's a good fit. We have capacity. Not everyone is a great fit, but I'm getting some terrific feedback from folks, some of which who've chosen to work with us and others who've just said, this is amazing. I'm going through this life's process and I've learned a lot through this and I continue to listen. So thanks for your continued interest in financial planning and investment management and all the things we talk about. Today, I'm going to introduce our guest. His name is Will Gibson. He's a chartered financial analyst, senior analyst with Nasdaq Dorsey Wright. They are a firm I've used and been familiar with for probably 15, 20 years. They've been integral into the development of my process. We call it our process. Our stands for objective, unemotional, and rules-based. So they're really the masters of this. They do a terrific job. Will, thanks so much for being here.
Thank you so much for having me, and I appreciate the introduction. I'm excited for the conversation.
Oh, me too, 100%. And I think our listeners will learn a lot and get a little deeper understanding of some of the things we do. Hey, do you want to talk a little bit about what you do and how you got into the business and all that kind of stuff? Or why don't you go ahead and share some info?
Yeah, I can certainly do that. As you can maybe tell by my voice, those listening to me on the podcast, I have a boyish monotone voice, as I've been told. So I am young. I'm on the younger end. I got interested in the business, being the investment world, really during the great financial crisis. I spent a lot of time at my grandparents' house. Both of my parents worked in the airline industry, so I stayed with my grandparents a fair amount. He was a NASA engineer and essentially became frustrated with his financial advisor during the GFC. And I sat with him, kind of saw what he started doing with his stock portfolio and his investment portfolio. Then that compounded into my years through undergraduate school and professional life. And on professional life, as you mentioned, I'm a senior research analyst with Nasdaq Dorsey Wright. My day-to-day is involved with producing technical research for our clients, mainly financial advisors, talking over the phone, via email, helping them refine their investment process, understand models, market trends, and be correctly positioned to help their clients manage the markets in the best way possible.
Yeah, that's great. That's great. We have a lot of NASA around here. We're right near the Jet Propulsion Laboratory. Interesting background. And I work with a number of these folks at NASA and Caltech. And it's really, when I was starting the podcast, we were actually going to call it's not rocket science, but we took a little different direction. So
Right.
Pleased to hear about that. Go ahead and share more, a little bit about what you do. And I can also explain how I'm utilizing it. And really it's clients are direct beneficiaries of, you kind of think of NASA, some of these technical measurements that somebody's watching the instruments to give you information to make decisions is an analogy. That was interesting. You kind of learned from you sharing this time with your grandparents. That's great.
I guess to be a bit more specific about what do we mean by technicals, because that's a term thrown around the finance community now. It's definitely thrown around the YouTube and TikTok and whatever other social media platform. It's become a bit of a buzzword, especially during COVID. So much retail investor interest sparked, which I think is a big positive in the long term. But I think technical research and technical analysis has gotten a bad rep, and especially for firms like ours that have been around over 30 plus years, we don't want to kind of confuse and present vague ideas of what we're doing. So to be clear, we use point figure charting as the backbone for our technical research. It's a very old form of charting. Charles Dow was one of the earliest proponents of it, kind of co-founder of the Wall Street Journal. So we've been using it for quite a long time, since the late 80s to be specific. It informs our process. So we use the charts to give us objective buy and sell signals for asset classes, sectors, individual stocks, ETFs, mutual funds. So I'm looking at the market through that lens. It helps us eliminate a ton of noise. It helps us navigate from headlines to real material changes in supply and demand, which we believe at the end of the day are what drives prices. As for what I really do, like I said, I write research through the lens of point figure charting. I help develop models on our system that advisors can follow and other investors, models such as stock rotation models, sector rotation models, asset class level models that are objective, systematic, and turnkey. I do a lot of indicator work as well. So we have participation readings, which is a fancy way of saying how many stocks are doing well in the market. What have markets done typically when you see these types of readings before? So overall, just trying to give as much insight and systematic, objective, actionable ideas to our clients.
It's really helpful. I've been following it, like I said, at least 15 years now, and it takes a while. It's a little like Greek or something, but it leads to a deeper understanding. It's not the only thing out there, but you mentioned these reports. I consume them. I'm on your system virtually all day. I share that sometimes with clients where they start to get some sense of what we're doing, participation. I feel like it's an important factor and sort of stacks the odds in their favor of making more correct decisions and avoiding bad ones. So it's just an integral part of the process. But yeah, go on, please. Yeah, it's really helpful. I also have a team. I kind of consider you guys, you may not know this, part of what I call a value added support team. So we connected individually. I called in a couple weeks ago. I can always access you and your team. And I had some questions about a couple things and just to get some different perspectives. And it was super duper helpful. You jump right on the call. And so I don't know that everyone understands that, but ours is a very much of a team process. No one's at the mercy of maverick talent here, but go ahead. And you guys have been really terrific. So that's why I utilize the service, pay a good amount. I'm happy to do it. It's been a good investment. I think it helps clients. They don't always know that's going on, but it is. Yeah.
Well, thank you. I'm glad you've had a good experience. I like being here. We're all nerds for this stuff. So when people call in and ask about a chart, or they ask about, hey, what should I do with this client's portfolio? What should I do with this massive allocation in NVIDIA stock that they have accumulated through their employee stock purchase plan? How do I reduce cost basis in an efficient way? What does the chart tell us? Where's the resistance? Where's their support? Things like that we love helping people with. We're nerds for it. Never feel bad reaching out via call or email. Something that I want to get back to as well about, and I think it's great that you share some of the things that you see on our system with your clients. There's this whole idea, and I think we'll probably get to this a bit later naturally, that complexity is alluring. So you'll see these people online showing their trading accounts, and they're talking about all this fancy analysis that they're doing based off the fact that it's October and it's a Tuesday and it's between 70 and 78 degrees and the stock just moved up and down by 7 cents in a certain pattern. Just ridiculous stuff that you're seeing out there. And complexity, again, is alluring. Morgan Housel's a great behavioral finance writer, and he kind of implanted that idea in my head. But what we're doing is to be very simple. Like, we do not want to be complex. Our system can certainly maybe feel that way at first for people that are just getting used to it. But at the end of the day, we're just tracking prices. We're tracking what's going up, what's going down, what's going up more than something else, or what's going down more than something else. So that's what we're trying to get at. Really simple, overarching, who's leading, who's lagging in the market, where's demand, where's supply, and we're trying to keep our investors and clients focused in areas where there is proven demand. Because, and you brought up this before, I've studied some fundamentals for a long time. You can have the best company in the world, but until the market agrees with you, it's really no good, at least in public markets as an investment. You can be right on the revenue. You can be right on the earnings per share. You can be right on all of your catalysts. But unless the stock market agrees with you, then that stock price is going nowhere. So we're a great complement to the fundamental side. We have tons of fundamental clients that come to us for that kind of technical overlay to say that, hey, we know this is a strong company, but is this also a strong stock? So that's a lot of the questions that I get from people as well. And not just stock level. We do this fund level, asset class level, all the way down and all the way up.
100% marrying those two together, the right fundamentals and the right technicals, the relative strength, that can be extremely powerful. I can recall Microsoft, it's been incredible, but prior to like maybe 2014, it really kind of flatlined for maybe 10 years until it took off. So to sit on dead money, and the market's sort of this ultimate crowdsourcing platform for interpreting everything. It's pretty smart to see what's going on and all the info it interprets, and it tells you a lot. It was on a simple supply and demand level. So go on, please continue on.
Yeah, that just kind of jogged my memory about kind of crowdsourcing, what people are voting all day on what the price of a security should be. That reminds me, we put a piece in our report. This was probably years ago. I haven't seen it in a while, but we ran the Who Wants to Be a Millionaire analogy. And if you look at the stats on Who Wants to Be a Millionaire, I haven't checked them in recent years, but when we looked at it, what was it, like phone a friend, and then you got like a 50-50, and then there was something about you could source the crowd, something like that, where you could get a crowd vote. And there is some wild statistic about how often the crowd is right on the question. So to draw the comparison back to markets here, we are, like you said, kind of all day sourcing what are people willing to pay for this stock? What are people willing to pay for this ETF mutual fund asset class as a whole? And we're displaying that as clearly as we can via our point figure charts and the charting on our system, via our indicators. All of that is designed to say, where is the crowd determined? Like, where has the market determined that there is strength? And like, where is their demand? And then at the other end, where's their supply? Is there kind of no action for the market right now? And we don't claim this to be the end all be all by any means. We're not great contrarians. We're not value investors by any means. We are momentum and trend followers. So we're trying to say, what is the trend of the market? And we want to be a part of that trend until proven otherwise.
Right. And that's just a nuance. I'll work with a lot of folks who maybe had been just do-it-yourselfers beforehand, which can be great. But a lot of times, if we partner up, there's a lot of value I can bring and to put a real process around it. Typically, I don't see them having that well of an established process. And I think I'm actually being kind. Most of the time, they don't have any process. They read a periodical. Maybe they know how to buy, they don't know when to sell. They have a hard time interpreting this, knowing. I mentioned to a lot of clients the 0, 1, 2, 3, 4, 5, the good sit, if it's north of 3. That's just a really helpful framework. Another place where there's allocations to be made. Sometimes somebody needs to free up 20 grand for some expense on the home, for example. Where are we going to pull it in the portfolio? We might look at gains and losses, but we want a real framework to sort of order where that should come from and what should be left invested. And that's just really helpful. That comes up a lot.
Yeah, something that you just jogged my memory on about talking about individuals that want to manage it themselves. I think there's a place for that. I think it's a great learning opportunity. But something that people forget is oftentimes they are their own biggest investment risk. This was put a lot better from G.K. Chesterton, who was a philosopher and writer in the late 1800s, early 1900s. The Times supposedly sent out an inquiry to famous authors asking what's wrong with the world today. And Chesterton responded simply, "Dear sir, I am," period, was his reply. And I think there's some really applicable truth in that to the context of investing. Like I said, I think the biggest problem is sometimes ourselves. We're prone to highly emotional acts of overreacting and underreacting, or we become overconfident at times in bull markets, or we become cowards during downturns and we don't see washout scenarios. So I think people need to reconcile and realize that we oftentimes get in our own way. And Morgan Housel, again, a great guy, great books, podcasts, do everything you can to not interrupt compounding. And a lot of that is getting your emotional self out of the way.
And it can be tough. It can be tough at times. I've literally had to tell people, turn the TV down, stop reading this. go take a walk.
Yeah.
Well, we have a dialogue around these things in the behavioral finance, and it's kind of like your doctor. I mean, most of the time you're not calling that person, but you're paying attention to your own health. But sometimes you want a consult. Is this normal? What's this number? How do I interpret this lab test? You want some partner on that, and especially if things get more serious.
Yeah, something else too. I've seen individuals get a lot more interested in markets, like I said before, I think is great, especially a lot of people my age, where during 2020 they had been working for long enough to have funds that they could invest in the market. But something too is that a lot of people were getting into individual stocks. You had stocks doubling, tripling in a short amount of time. I'm sure there's been plenty of other periods of market history that we could highlight where this has been similar. But if you look at some of the reasons that people buy stocks or buy an individual name, the reasons that they buy that stock, you can't directly link to say, this is why the stock went up. So to say differently, somebody bought GameStop before all that mania came about. Maybe they actually like the fundamentals of the company. They had no idea what was about to go on with the Reddit community and the short squeeze and all of that. The whole catalyst, the whole reason for their pick was not why the stock went up. So it's really hard to manage how successful you are in that fundamental individual stock picking realm for individuals. But then if you look at the technical side, we can justify why we're buying something. We're saying, hey, this stock is higher rated than something else. It has more technical strength. It's on a point and figure buy signal on its trend chart. There's plenty of reasons that we can point to say this is why we're buying the stock, is because there's momentum with us. We're not having to be arbitrary and vague about trying to link our rationale to why the stock went up, if that makes sense.
Yeah, it makes total sense. Sometimes we get these. I never got involved in that. Every time I drove by the GameStop, I couldn't understand it. I noticed there's a Netflix series. I'm like, I have no interest in that. Or we'll take questions on Bitcoin. But we're generally dealing with, quote, the millionaire next door, the overnight 25-year success story. They want continued growth, but they want stability. And we're trying to deal with quality. So we're trying to really devise a process for having them own super high quality things, but also adding the layer of what's in favor, what's going up. Are there other factors like a strong dividend? How's their growth? How's their balance sheet? What if interest rates do this or that? How will this impact them? Things like that. But these are important inputs. Yeah, and
Yeah.
it's been super helpful. Keep going, please.
Yeah, I was going to say,
Yeah.
I'm glad you brought up client type, because that's the big component to process. That's certainly something that we take into consideration when we are talking with our clients, because the investor experience is so important. I think more so than people think or they will admit. So not only should a process or a system look good on a back test, on paper, or even economically, but it also needs to look good in terms of a perceived end user experience. In more simple words, if someone can't hang on and stick to the process, then what does it really matter at the end of the day? We could have the best performing model on our system. Point to point looks great, but that experience between point A and point B could be so volatile that no one could follow it and they would bail along the way. So I think that's important to keep in mind, especially with people that you're talking with, whether depending on what life stage that they are in, somebody towards retirement. Of course, you need to be a lot more conservative with their portfolio. Wealth preservation is oftentimes what's to be focused and not high beta growth names.
Right. Or maybe income or stability. So we can use your system and that process to determine things that are in favor, but also have a high dividend. That could be a good combo versus sort of these value traps, a high dividend, but no real demand. I'm speaking later this morning with somebody. I'm being introduced to a client who she's looking for Christian-based values and certain screens she wants on there. We can apply that, but also look at things where there's demand versus it's just very helpful to folks and to put that on their plate. We review a lot of portfolios when folks are introduced to us. I do that at no cost for folks. I just go right through it. I'll look at everything, but also utilize your system to really say, what is the relative strength? How does this rank against its industry, the rest of the market? And we want to put strong players on the field. And a lot of times, well, most of the time, they've never seen anything like it once we go through this complimentary review. And I've literally had people say, I've been investing for 25, 35 years. I've been with 7 advisors. Nobody's ever explained this to me. Now this makes perfect sense. And sometimes they've owned things for a long time where they're like, oh, that kind of validates what I was thinking, but I never really had a way to verify that. And so I simply tell them, I mean, if you're working with an advisor or a team and they have this effectively going on and they understand and they're doing this, you'd be crazy to change. You know, you got to stick with that process. If they don't understand it or you're not utilizing it, you have to. It's really imperative to have those things on your side. But that's
Yeah,
just my experience. Yep.
no, that's very valid. That's something we consider as well. There's this idea too of, I think 3 kind of big ideas here is that pulling weeds in a portfolio is extremely valuable, or pulling weeds in a garden gives space for flowers to grow, right? They're not sucking up the water. They're not sucking up resources that could be deployed elsewhere to be a much better product. So pulling weeds, I think, is a huge thing to do in portfolios. And I'm glad to hear you all do that regularly. And momentum and trend following, I've mentioned, are experts in. That's how we advise our clients. That's what it's designed to do, is pull the weeds, cut losers, and then let your winners run as long as possible. There's countless studies to show how many listed public companies will actually outperform the market, let alone not go bankrupt or be acquired in X amount of years. It's a surprisingly large percentage that really never beat the market or outperforms. Or having a system to continually push your portfolio towards strength, get the weeds out of your garden, and let your flowers grow and take up as much sunlight as possible is one huge thing. That is kind of my thoughts on what you were saying there. And then some other things that I would bring up, and I'd be curious your perspective on this with clients. There's this whole idea of time in something versus timing something, because a process, I think, gives you dividends with time. Not trying to time a process as in when to use it, but to use it through all time is where you see the biggest value. And I know maybe, and you can speak to this more so, I know we have people that come to us trying to time our models or trying to time our indicators, determining when they're going to use certain signals. That typically doesn't work because you have to stick with the process and stick with the model for the long time. That's where you see the real value. So I'd be curious with you, if people, do they like to
Yeah.
time something better, or do they want to just, are they comfortable just giving it time?
Well, depends. The timing of this, it can be notoriously incredibly challenging. And I don't claim to be good at it or that's a value driver for clients. I think a lot of individual investors think they can. I think it adds a lot of confusion if they're trying to time things because they really have no idea. They have no control over on it. So we want to focus on quality, things that are in demand. It is just notoriously difficult and often they're sort of just chasing things they don't understand. And I think more often than not, it leads to bad decisions. So we like to add a lot of process around maybe the timing. This makes sense. It's not overbought. Where is it? How is it ranking? What is it doing? What else is going on? But time in something is really important too. I mean, I think back time and time again, the huge winners, the Apples of the world, the Microsofts. I don't think I've ever heard a single comment from anybody who spent any time in there. The only comment I've ever heard was, I wish I'd had more. So just looking at a portfolio the other day, you know, they put $3,000 into Apple some time ago. This isn't a recommendation here. Now it's worth 120K. So I remember where we were sitting when we made that decision, and then they didn't get into more. So it's both of those, but trying to time it, or even NVIDIA right now is a real bit of a head scratcher. It's just doing so exceptionally well. People saying, should we get out of it? Should we get into it? We kind of walk them through the pros and cons through a process, but we like people to be more conceptually. The Millionaire Next Door, again, it's the overnight 25-year success story. This whole sort of get rich off this quickly off this thing. I hate to tell the whole world it's not that. It's often it's a time. It takes some snowball. Even Warren Buffett didn't get rich super quickly. He's a older. It took him a long time, right, to get as wealthy as he was. But it's a long answer to your question there. But hopefully
No,
that helps. Yeah.
that's a great answer. Time is an undervalued asset.
Yeah.
It allows for compounding to take place, which is what do they call it? I think Warren Buffett may have been the one, seventh wonder of the world or eighth wonder of the world, something like that.
I
There's
think it
some,
might have been Einstein who said it, maybe with
you know
respect to
what? Yes.
compound interest. So with his mind, he said that is, I forget how, but the gist of it was this is a phenomenon that's one of the most powerful in the whole universe. So if you
Yes.
let it work for you effectively. So that,
Yes. Yes, that's right. No, I appreciate the correction there. That's totally right. And to let compounding do its thing, oftentimes the best thing to do is nothing, which is so difficult. Like for our technical ratings, maybe we'll have a stock rated as a 5 for 10 years, 15 years. So the best thing to do is just let it be. Keep buying the stock. Don't do anything different with the name. People like change, people like headlines, but again, oftentimes the best, wisest, fiduciary-esque thing to do is to leave a portfolio as is, or if the market trend still dictates strength, that's the way it is. We have macro asset class rankings, and for a long time, probably for 7+ years, you saw one asset class, domestic equities, sit in the top position, and there were many headlines that would tell you that should not be the case. But it stayed there for years and years, and stocks and funds stayed rated highly for years and years. So we were telling people, no, don't do anything. Keep the asset allocation the same. The trends of the market haven't changed, which again is a really hard discipline to follow. So it's much easier to say than do that. And I'm sure implement that in clients' portfolios.
yeah, it comes with time and wisdom. And you guys have helped me learn a lot of that too, or your process sometimes. But if the trend is still strong, just continue riding it. And sometimes we feel we have to make changes. You mentioned the weeds versus the flowers. You never know exactly when the weed's going to come up, but if you pull them regularly, if you don't have them, but if you kind of maintain them, you don't have a lot of problems going on. But when you do see one pop up, when you do see these changes, it's meaningful, right? If something really goes from demand to supply is in control, a lot of times we don't understand it right away. Why? Everybody wants to know why. You guys have helped me learn a lot of times the answers to that will come over time, but you don't exactly have to know why instantly. You just might need to know, hey, something's changed. The whole momentum has changed. People are not interested. I should pay attention to that. Maybe I should be doing something about that. That's kind of an alert. If you're in the cockpit and this light goes, you want to know right away. You want to read the instrument. Process wise, it's been great. Folks at home have no idea, especially if they're, living busy lives, or they're retired, or they're running kids around, or in their career, or playing pickleball, or on a cruise, or whatever they're doing. They kind of rely on us to look at that and to share that and just let them know what the major points are. And typically over time, as they gain confidence in that, they sort of delegate out and say, hey, go for it. You know what you're doing here. That's why I'm employing you for the process that you're running, and communicating it to me and helping me understand things a little bit better. But it's great. There's so much changing in the world right now, with so much technology and AI. And so it's kind of a good guide to see where the hockey puck is going.
Right. And technicals too, they're great at telling you when you're wrong and when you're right. Like I alluded to before, you can have great company, bad stock. And what you're saying here is, hey, something's changed for this individual name, or something's changed for this fund or asset class. We don't know exactly what, but we know something has changed. And in order for us to stay right, we need to be very clear on what we're looking for here. So technicals can give you that kind of change of wind coming.
It's great. I mean, I have a lot of analogies here to kind of health and wellness, but it's just like running your blood test or you just get the numbers. The numbers are the numbers, and they'll tell you what's working and what you might need to work on. It's great to have a system like that. Again, it's not the be all and the end all, but it's really important information. And when stuff is looking good or it's in the range, that's terrific. You can be excited about that and carry on. If something's out of range, you want to change it, but then you just retest it again after a reasonable period of time. And it's kind of like looking in the garden. Have any weeds come up? Are the flowers still flourishing? Has the season changed? Is this moving in or out of favor? It's that constant monitoring. And a lot of times you don't have to make that many changes.
Point and figure charts are unique from a lot of other technical charts because they're only plotting action when you hit sufficient price thresholds. So we're not going every single day and plotting the closing price. We're looking to say, hey, we're only going to plot changes when we hit certain levels. So yeah, point and figure kind of builds in to eliminate some of that market noise and to keep the narrative technically the same if nothing has changed. So that's a big talking point that we'll say as well. We'll see a stock sit in a single column of X's, which is maybe some jargon for many listeners, but we'll see a stock sit unchanged for months at a time, maybe even years at a time. But until that technical story changes, we're not going to change our position.
Right, exactly. So there could be a lot of noise around the data. I
Right.
explained to a lot of clients, I'm sort of your noise canceling headphones, because there's a lot of meaningless noise, but sometimes there's noise that really matters or says, look, it's time to pay attention and see what's going on here and focus on it. And I think that's a really helpful barometer for clients. It's just been super helpful to my process, I think, to share with clients, all this column of X's and all that. I don't sit around and do this all day, but you guys have made the system easy where I follow your research. I'm in the system. If I get a question, I have a very objective way to look at it, good data, and we work that through the process, and we don't deviate from the process, because if you don't consistently follow a process, then you really don't have any process at all, is the way I view it.
Exactly. We've been through that many times with our models or our products, whatever it may be. When they go through periods of underperformance, that's when we get people trying to time the momentum trade or try to time getting in and getting out of their process. And like you said, I would absolutely double down on and say, if you deviate from your process, then it totally negates the whole reason you set up your process in the first place. So having something that's scalable, followable, rational, as well, reasonable, is totally important. That's something that we try to build through our models, our research, and so forth.
Right. And speaking of what you're just saying there, I know that the momentum, some of that as a factor, was out of favor for a really long time until recently. That can be frustrating, but yet we stuck with it because we knew it was a really good factor. And then it was so long out of favor that it was likely that it would revert to mean. And lo and behold, it's reverted to mean dramatically, and it's dramatically outperforming this year. So some of those nuances really matter, and they don't escape your observation, our observation, and we share with clients why not to change when it's time to stay on the train versus maybe change tracks. But
yeah,
that's been a biggie. And we're kind of impartial to it all. We don't really have big expectations. We're just, and you share with me, but we just watch what's actually going on. It's kind of like watching a football game. You can get kind of caught up emotionally in this player. He should have done that. But when you watch it a second time, you can sort of see maybe why these decisions are made, or it slows it down a little bit where you understand it. It's a little bit how I've viewed it over time. So
that's a great way to look at it.
Yeah. Hey, we're running up a little bit against time. This has been so helpful. I just wanted to let folks know that, kind of introduce you, and I've shared you guys with a lot of clients that I have this process, and you're a great resource. Any other kind of salient points or thoughts you might want to start to kind of land the plane on and close up on?
I'll just say one and a half things. That the half point I'll say is that, as speaking from a momentum shop, it's great to see the factor come back strong to start the year. We hope that continues. We have some evidence to believe, I think, that will continue. But on the full point that I conclude with today, markets are at or near all-time highs. Bearish sentiment continues to dominate headlines. And I would say this, and this is, again, wisely said by others, but bearishness is typically seen as being smart and considerate, while bullishness often begets more naivety or ignorant responses. So that's all I want to say, is that bearishness can take a lot of headlines. Kind of bullishness, trend following, meaning in this case the trend has been higher, that hasn't changed. That's probably not going to generate as much headlines. If you look at the data, picking market tops and being bearish at the tops is a lot more difficult than you would think. So until those trends change, that's where a lot of our models and indicators are positioned right now.
It's really nuanced. I think of all the folks who, how prevalent a recession was, the prediction for so long, but market's not saying that. So it's always a process unfolding. And that's why we like to partner with folks like you to help clients interpret it. So thanks so much. I'd love to have you back for more of this, so we could just kind of riff on process and what we're seeing. Don't want to put you on the spot. I think I've said that for the last several guests I've had, because they've been so terrific. But really appreciate having you here, Will, and it's been a pleasure. And thanks everyone for tuning in, and we look forward to seeing you on the next episode.
Thank you for listening to the Millionaire Next Door podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Signature Estate and Investment Advisors.
Signature Estate and Investment Advisors, LLC, SEIA, is an SEC-registered investment advisor. However, such registration does not imply a certain level of skill or training, and no inference to the contrary should be made. Securities offered through Signature Estate Securities, Inc., member FINRA SIPC. Investment advisory services offered through SEIA LLC, 2121 Avenue of the Stars, Suite 1600, Los Angeles, California, 90067. Telephone number 310-712-2323.